but there was this story in Thailand. There's this river, the Lompeng River, and basically every year in the wet season it floods, and water's rushing through, and it dislodges all sorts of minerals, and of course gold is coming out. And then during the dry season, farmers and other kind of basically anybody will start going into the riverbeds now that the river has receded and start digging around for gold. Have this very pure gold that's there. And that's kind of, I read this story and thought, well, you know, there's a lot of, that's a good analogy for kind of seeing as when you have a marketplace that, you know, you have floods come through and then you have kind of drought seasons, and then where do you find value as the water recedes and you start seeing things that weren't there before? And that's kind of where we see, you know, either with high oil prices, or it's interesting to note, too, that the word currency has the same root as the word current, like a river current, you know, that kind of flowing. That's more of an aside, but still the fact that, you know, looking for that value and trying to search for it from what has been dislodged from either a flood or even a drought. And I think, you know, in terms of 2008, certainly was a drought economically that revealed all sorts of opportunities. But even with oil prices and what they are and what they were in 2008, can also identify or create value or put value out there that might be of interest, you know, in furthering steps. And Steve, I don't know if you wanted to comment anything at this point with that.
I think we're trying to tie in the fact that things look really good when the tide's up. When a river's full, things look bountiful. And it's typically common in the stock market. People talk about equities, investments when things are good. Back in 1999, it was one of the more extreme cases where people were jubilant because of the dot-com craze, the things like that. But when the dust settled, when the dry season hit in the stock market, as it has there in this picture of this river, I think that's when you get the opportunity to dig up those, quote, nuggets of gold there, call it what you want. But it's very hazardous in my experience, and when you're looking for equities, fixed income, or most recently we've been, in the last couple of years, involved with mortgage-backed securities. You do have to wait for the river the drought season to enter before you can really become a value investor. As Robert said, price and value go together, and so we're looking for those times, and that means sometimes you're not invested. You do have to wait for these events to go through, the cycles to happen, and you know, whether it be a commodity in oil, a financial security, like a bond and or fixed income, or any other type of industry, truly to get involved comfortably, you have to be patient, and you have to wait for these seasonality things to move through, or cycles in this case.
I think something we saw specifically with the oil trade. For example, in 2008, prior to the collapse, we have these incredibly high oil prices that people are going to go drill where people have not drilled before. They're going to go and find new resources because now it makes sense that they can. They can start finding products, or even refining products that might be, in the crude might be heavier crude or not as high grade of crude, because the profit margins are there. So what we have seen, and a lot within the oil industry in particular, but take that as an example. A lot of companies would take on significant amounts of debt during those periods of time to finance these operations. And then what happened? We had immediately following kind of the surge, we had a collapse in the economy, which took a huge tumble, which affected credit markets, you know, severely. We have the Deepwater Horizon, where they had a moratorium on drilling in the Gulf, which impaired many of the assets these people had financed so expensively that now they were even more impaired. They couldn't use those resources that they had, took a lot of debt out to produce. And we have other kind of situations as well. But as oil prices have recovered, and we've seen other kinds of things play out, like moratorium being lifted, and we're starting to see recovery of these kinds of assets. And this debt, this is just one example, but we've seen companies that have had have financed themselves with very high interest rates of debt And now that things are starting to look a little bit better, they're wanting to refinance that debt. And that's been a significant area in which we've been looking across the board at opportunities such as that, where they're in situations where they just need the money. And so they're willing to pay a high interest rate. But now that things become a little bit better, now it makes sense for them to try and refinance, if you will, or call those bonds or buy the bonds back. And we've had significant success in that realm and also finding those types of opportunities. So that's in particular where you see high oil prices create that rush to capital. And then you can see a decline. And then now with this kind of second wind of oil prices, we've certainly seen them getting that wind back in their sails, which has allowed them to begin to consider refinancing or other ways to finance, which are getting out from under their higher interest rates that they have had. That kind of goes within the fixed income space. That certainly has been an area where we have been, our portfolios, if you take our entire portfolio here, over 60% is in fixed income. And so that's a significant portion. But that's been, whether it be in the oil and gas industry or even housing or mortgage insurance companies, those kinds of sectors have been areas in which we have been finding kind of that overfinance, that basic overhang, and then being able to purchase that debt at a reduced price and then be able to allow for either value to return in the marketplace that lets these companies that debt to appreciate in value, or the company itself decides to, I want out from under this high interest rate and then pay us to take the debt away from them. That's been a general strategy kind of for us in the fixed income space, but it can be considered in stocks as well. You know, take for example, if you're a company that had assets in the Gulf and had assets in Libya. You're greatly impaired if there's a moratorium on drilling and then you have an overthrow of the government there. The question is there value there? And that's where we come back to really looking at what is the difference between a low price and a mispriced. And this is where the value investor is very important, because anybody can buy a low price security. And there are things that are cheap and legitimately cheap. There are a lot of companies out there that will probably never appreciate in value. And that's an important distinction. But sometimes the market can be overly harsh and can judge something too much, and that price can actually be a result of a mispricing, which is where we try and find something where we derive value or we see value, and we're trying to make sure that we are capturing that. And that's where I kind of